Hi students, how are you? Can you hear me? If you face any problem, communicate with me in a chat box here. Good evening. Can you hear me? Okay, that's great. I welcome you all in the first class of basically introductory class of SBR Strategic Business Reporting. I'm your tutor, Abu Bakr, and we will learn, and together we will learn the Strategic Business Reporting SBR paper of ACCA journey. The paper which we are going to study is SBR Strategic Business Reporting. If we talk about or discuss the journey of this paper in ACCA, this journey started from the paper of financial accounting, then we have financial reporting paper, which is known as FR or F7 paper, and now we have a final paper of reporting which is known as SBR, Strategic Business Reporting, and we are going to learn the international version of this paper. This paper has a specific version like UK or Singapore, but our version which we are going to study is SBR International. Now, in SBR, obviously, the knowledge from the previous paper will be very useful, or I would say a significant portion of SBR will be consist of the topic which we have studied at financial reporting level or at FR level. So FR is still relevant and very much relevant at SBR level. And one more thing, this paper of SBR is also useful for AAA paper, Advanced Audit and Assurance, because now in Advanced Audit and Assurance paper, there are questions, there are case studies on the basis of accounting standards. So SBR, the knowledge which we will get at SBR level will also or will be very useful for AAA as well. Now, what we are going to learn in SBR, obviously, in SBR we are going to learn the accounting standards. Obviously, accounting standards we are going to learn about how to report the financial transaction in a financial statement, how to report the financial transaction in a consolidated financial statement. Obviously, we are going to learn the cash flow statement and many more things. But primarily, we are going to study the accounting standards. The main difference between FR and SBR, the knowledge is very much same, but the difference between the financial reporting and SBR is the exam style. Exam style is the main difference between financial reporting and SBR. The financial reporting is more numeric based. There are MCQs questions, there are OTK studies, but in SBR it will be more knowledge based paper. It will be more descriptive paper. It will be more descriptive paper. Descriptive means it will be more discussion based paper. There would be a case study, and on that case study we have to apply our accounting knowledge relating to accounting standards. So it will be more like case study, descriptive explanations, discussions will be in a strategic business reporting in SBR paper. That would be the main difference. And obviously, as you know, that SBR is also now a computer-based exam, but it is not like FR. It is not like FR. In FR, we have OT question, we have OT case studies, multiple choice questions, fill in the blanks we have in SBR, at FR level. But in SBR level, we don't have any multiple choice question or OT question or OT case study. There will be a long questions, and we have to answer these questions using the spreadsheet tools or Word tool on a ACCA practice platform. And I will give you a journey on a SBR platform as well. But the paper will be different. Like it is a computer based, but by computer based does not confuse that there will be multiple choice question. There will be no multiple choice question. There will be no objective question. There will be in total there will be four questions in SBR, and they all will be a long question from 30 to 25 marks. 20 to 30 marks question will be in SBR, and there will be long constructive question which we have to answer using the spreadsheet and the Word format on ACCA practice platform. Now, if I discuss with you the exam pattern, that how the exam will be. SBR have two parts. SBR exam will be consist of two parts, part A and part B. In part A, we will have two questions, question number 1 and question number 2. Question 1 will be of 30 marks, and question number 2 will be 20 marks, and in part A we will be having total 50 marks. Now question 1 will be usually it is from group accounts, and from any accounting standard. So 30 marks will be consist of group accounts and on any accounting standard which will be based on a case study in which we have to discuss a specific accounting treatment, maybe from financial instrument, maybe from provisions, IAS 37, maybe from intangible asset, or any other area of the SBR syllabus. And a question number 2 will be consist of 20 marks, and in question number 2 there will be an accounting issue, any discussion on accounting treatment along with ethical implication. In question 2 we have an accounting issue and the ethical implication of the accounting treatment or behavior of the managers or the employee of the company. And in the part B we also have two questions, question number 3 and question number 4, and each question will be consist of 25 marks, and both questions will be from accounting standards or conceptual framework or any other area of syllabus. So for example, it might be from accounting standard for SMEs. We have a topic with the name of alternative performance measurement, but mainly the question number 3 and question number 4 will be from the accounting standards and descriptive question. There will be a case studies on which we have to discuss, and total marks are 50 And let me tell you, out of 50, 40 marks will be from accounting standard, and we can say 10 marks will be from the other area of syllabus, like conceptual framework, like small and medium enterprises, for example, alternative performance measurement. Such topics will be tested. So we can say 90% of your exam will be based on accounting standard at SBR level, and you need 50% marks out of 100. We have total 100 mark exam, and you need to get 50 marks to pass this exam of SBR. Okay, this is your exam pattern, your exam style. Any question? Okay. Now let's first discuss the course plan, the plan of action. That is a course plan, how we will conduct the syllabus. These are the estimated lecture. The number of lectures can be exceeded with these numbers. Okay. And now the first we will start from the provisions, contingent liability, and contingent asset, FRL for sale, discontinued operation, IFRS 5, and borrowing cost. That will be the first topic. And in this lecture we will be covering the topics which we have studied at FR level. IAS 37, IFRS 5, IAS 23 were a part of your F7 paper as well, and they are still important at SBR level. There will be questions from IAS 37 and IFRS 5 in SBR. Then the second lecture or the third lecture will be on IAS 16, property, plant and equipment, investment property, government grant, intangible assets, impairments, and ethics. The ethical implication or ethical framework for an accountant. The mainly in these topics we are covering the topics of F7 or FR paper. Then we have the third lecture, estimated third lecture, accounting policy, IAS 8, Ifrs of reporting data, IAS 10, segment reporting. Segment reporting is a new topic for you people. It is not part of your F7 paper. In segment reporting, basically, just assume a multinational company which is operating in a different geographical areas or a different product lines, and that is a listed company, and user of the financial statement need the information regarding the specific product or specific geographical area. So in that case, we have an option to do a segment reporting. We report the financial performance of a specific geographical area along with the financial statement. That is known as segment reporting. For that, we have an IFRS 8, related party transaction, IAS 24. Again, it is a new accounting standard for you. Related party transaction is a disclosure-based accounting standard. Related party means the parent, subsidiary relationship, associate relationship, key management person of the company. They are related parties of the company. And whenever there is a transaction between the reporting entity and the related party, there is a requirement that such transaction must be disclosed in a financial statement. For that purpose, we have IAS 24. Then we have IFRS 13. This is an accounting standard on fair value measurement. Then in lecture number 4, we will be doing IFRS 15 revenue. This is a, a big accounting standard, so it will take a time. So IFRS 15 we have in a lecture number 4. Then we will be having the test. After that, we have employee benefit IAS 19. This is a new accounting standard for you people. In IAS 19, we will study the accounting of employee benefit like salaries, pensions, provident fund, gratuities, how to account for. Then we have share-based payment IFRS 2. In IFRS 2, we will study sometime companies pay the consideration of goods and services in their equity, in the form of their equity, or the payments are linked to the value of their equity. Such payments are known as share-based payment. For that purpose, we have an IFRS 2. That will be a new accounting standard for you and very interesting one. Then we have IFRS 16. In IFRS 16, we will study about the leases. A small portion of leases we have studied already at FR level, but in SBR level, we will study completely the lease accounting standard IFRS 16, in which we will discuss the accounting for the lessee. We will discuss the accounting of the lessor. We will discuss the sale and lease back, lease modification, lease reassessment, and so many things like that. We will be studying in IFRS 16 lease. Then lecture number 8 and 9 will be on financial instrument, IAS 32, IFRS 9, and IFRS 7. Some portion of these topics we have already studied at F7 level, but obviously at SBR level, it will be at advanced level. We will study the financial instrument at advanced level. For that purpose, we have IAS 32, IFRS 9, and IFRS 7. Then lecture number 10 will be on IAS 12, accounting standard for taxation, how to account for the taxation in a financial statement. In this accounting standard, we will also discuss the deferred taxation as well. So IAS 12 will be the lecture number 10. Then we will be, after tax, we have our test number 2. And then from lecture number 13 to lecture number 14, we have the group accounts. We will revise the basic groups. We will study the IFRS 3, IFRS 10, joint venture, IFRS 11, accounting for associate and joint venture, IAS 28. We will study the business combination in steps and disposal. If steps mean if we acquire a subsidiary company in steps, first we acquired 30%, then we acquired further 30%, and now we have 60% subsidiary company step acquisition. Then we will discuss the disposal of the subsidiary here. We will discuss how to consolidate cash flow statements, and in these areas of in the group areas, we will also discuss the IAS 21. Here IAS 21. In IAS 21, we basically study the foreign subsidiary, how to consolidate a foreign subsidiary. We may have a subsidiary which have a different currency other than the parent currency, so we have to translate it and then consolidate it. We have IAS 21 here, which we will study here. Then we will study the consolidated cash flow statements, how to prepare the consolidated cash flow statement. We will learn here, and then we have any other areas, any specific areas which are important one, or maybe some technical article. If by that time, if we have a new technical articles, we will study at the end. So that will be the course plan. That will be the you can say the course of the action, that how we will conduct these classes. Okay, and this course plan will be shared with you, will be delivered with you people by the management. As far as the study material is concerned, dear students, notes will be provided to you. We will provide you the notes, the complete notes of SBR paper in a one volume. All the notes will be combined, and the practice exam kit will also share with you by us in a soft form. Okay, so the study material will be provided by the management to you people. Just give me, let me try. Okay. let me share with you people the practice platform, that how exam will appear. Okay, as I told you that we will be having section A, and in section A we have 2 questions, and the total marks will be 50. Okay, that will be the your exam screen. First of all, introduction, that the exam will be 3 hours and 50 minutes, and the guidance, as you know. Then we have the instruction. We will then exam summary. Okay. I think we have some internet problem. Website is not responding. Okay, I will share with you later on the ACC practice platform. Due to internet connectivity, maybe we are not getting it. The browser is not working properly. So we will look at later on that how the ACC practice platform will appear on our exam screen and what will be the question style. We will discuss that thing later on. So now, without wasting any time, as I share with you the course plan, we will start the topic. And as I told you that we are going to take start from the provisions, contingent liability and contingent assets. And contingent asset accounting standard is IAS 37. This is the topic from where we are going to take start. Provisions, contingent liabilities, and contingent assets. This is not a new topic, I know, for you people. This is a topic which we have already studied at financial reporting paper. But dear student, it is very important as well at SBR level. There is no new concept in SBR regarding provision. We have studied at FR level. We will revise it now at SBR level, but it is very important because examiners frequently give us case studies from provisions, contingent liability, and contingent assets. So keep this thing in mind. It is an easy accounting standard, but still very important one. So in IAS 37, we have three things: provisions, contingent liability, and contingent assets. First of all, let's start from provision. What if we define the provisions or a provision? The definition would be provision is a liability. Provision is a liability of uncertain time or amount. That is the definition of provision. That provision is a liability. First of all, it is a liability. But in this liability, the timing of the settlement of the liability or the amount required to settle the liability is not certain. That's why such liabilities are known as provisions. So that means to be a provision, it is necessary that it should meet the definition of a liability. If something is not meet the definition of the liability, then it can't be a provision. Okay, because provision is a liability. So what is a liability? If we define the liability has three components. Number one, it's a present obligation due to past event and number three, outflow of okay. Now tell me, is it sound is clear now? Everyone can listen me now. Everyone can listen me clear and loud. Okay. Okay. So now I have off the camera because there is some problem regarding the connectivity in the region where I am conducting the classes. There is a problem. Some work is going on, so I have to shut the camera. So we will conduct the class only through audio. Okay, outflow of economic benefit is probable. This is the definition of a liability. And if we have a provision, then it must fulfill the definition of the liability which we have discussed. Now, by present obligation mean that there is no alternative other than that we should fulfill the obligation. Present obligation means the obligation has been established. And this obligation is arise due to past event. There must be a past event due to which today we have a present obligation. And as a result of this, there will be an outflow of economic benefit to settle the obligation. If these characteristics are fulfilled, then it means the definition of the liability is fulfilled. Now, the obligation, the present obligation, it could be legal or it could be constructive. Legal obligation means the obligation which arise due to law. due to action of the law, and constructive obligation means the obligation which is not due to the law, not due to the action of the law, but due to the stated policies of the company, which is known by other people, and people expect that the company will fulfill their promises. Such obligations are known as constructive obligation. And for IAS 37, it doesn't matter that whether the obligation is legal or constructive, obligation will be obligation whether it is legal or constructive. Past event is also known as obligatory event. Past event is also known as obligatory event. The event due to which today we have a present obligation. Now, for example, let me give you an example to explain the definition. Now, let's take an example, a scenario. For example, we have a catering company. This catering company provide food for an event. Now, due to the food, 20 people died due to the quality of the food. Now, the people went to the court to seek compensation from the catering company. Now, in this case, the delivery of the food, the bad quality of the food which we have delivered is an obligatory event, is a past event, due to which now we have an obligation that we should compensate the effective parties due to the supply of the food which is provided by our catering company. Okay, so the present obligation that we have to give the compensation. Past event is the delivery of the food, and as a result there will be an outflow of economic benefit. So it means the definition of the liability. Now, if in this liability the timing of settlement of the liability, the amount need to settle the liability is not confirmed, is uncertain, then such liabilities are known as provisions. Now, in this case, in my example, basically it is your lawyer has told you that you have a present obligation, you have to give the compensation, but the final decision will be given by the court, and now the court can take 6 months or a year to finalize the case. So the timing is uncertain, and the amount of the fine will be decided by the court, and it is up to the court that the fine could be a $1 million, it could be a $20 million. So it will be decided by the court. So in this case, there is a present obligation, there is a past event, outflow of economic benefit is probable, but the timing of the outflow of economic benefit or the amount to settle down the obligation is not certain. There is some uncertainty. So such liabilities are known as provisions. You get it? You get the concept? Now, the accounting treatment of provision. Dear students, provisions are recognized in financial statement. Means the expense or asset will be debited and provision will be credited in a financial statement. We will recognize the provision in a financial statement. But the provision can only be recognized in a financial statement. We will recognize, but depending on some conditions. Number one, there is a present obligation due to past event. Number two, outflow of economic benefit is probable. And number three, cost can be measured reliably. So if these three conditions are fulfilled, then a provision will be recognized in a financial statement. We will recognize a provision in a financial statement. Expense will be debited and provision will be credited. If any of the recognition criteria is not fulfilled, then provision cannot be recognized. All the three conditions must be fulfilled. Now we have the measurement. When the conditions of recognition is fulfilled, then there will be a question that how a provision should be measured. Dear students, standard says the amount at which we measure the provision should be a best estimate. Best estimate means while measuring the provision, we have considered all factors. We have considered all factors. And if necessary, we also have an input from professionals regarding the measurement of the provision. For example, input from lawyers or engineers. For example, if we talk about the dismantling cost or site restoration cost, in such estimation, obviously, opinion of the engineers will be very crucial. And similarly, in case of legal cases, the opinion from the lawyers will be very important factor. So best estimate means we have considered all the factors while the determination of the provision. And any future change is also considered. Now, what does this mean? Now, for example, we know that we are going to make a provision. Let's talk about the warranty. warranty provision. Now, what is warranty? Can anyone tell me that what meant by the warranty? Warranty, when we purchase a product of any company, they give us a warranty. For example, if we purchase a mobile phone, the company will give us a warranty that if there is any manufacturing default, they will repair free of cost. That is known as warranty. Am I right? Now, for example, you have sold the product and you have estimated that you need a provision of repair in terms of warranty of $1,000. This $1,000 is based on your past experiences. But now you know that you are going to bring a new machinery, and this machinery will reduce the repair cost by $100. By $100. So when I will be measuring the provision, I will consider this future event, this future activity, that when I will bring a new machine, which is certain that I will bring it, and I will use that machine to repair the mobile phones, then the cost reduction which will be caused due to change in the technology in the repair cost will be considered while determination of the provision. You get it? You get this idea? You get this concept? Point number 4. Time value for money will be considered if that is material. Now, for example, today is 2022, and we know that provision will be settled in 2025. So there is a 3 years time. I know that in 2025 we need $10,000, but obviously what is the value of $10,000 in terms of 2022? So I need to determine the present value. So if the time value for money in a provision is material, then obviously we will discount the provision. We will consider the time value for money, and for discounting purposes, we will use the pre-tax. We will use the pre-tax rate of return. We will use the pre-tax rate of return to determine the time value for money. It is pre-tax. Pre-tax means before tax. Before tax rate of return will be used to discount the provision. So these are the 4 points which we need to keep in mind while measuring the provision or while measurement of the provision. Now, furthermore, we have 2 types of events where we will measure the provision. One is known as where is a single outcome is expected. And the second is where the large population is expected. Now, in case of single outcome, we will measure the provision with most likely outcome. Now, single outcome means we are talking about a court case. For example, a court case. Now, for example, there is a case for a compensation on a company, and the lawyer tell us that a fine could be $100 million, or it could be $200 million, or it could be $300 million. It will be $100 million, chances are 20%. It will be $200 million, chances are 45%. And it will be 300 million, the chances are 35%. Now, in this example, the most likely outcome is 45%. So, on the basis of this most likely outcome, we will measure the provision where is a single outcome is expected. Example is a court case. You get it? A large population. Large population means where a large outcomes are, number of outcomes are involved. And the example is a warranty cost. Warranty cost is an example where the large population is involved. And here we measure the value using the expected value method. For example, a company sold, let's assume a company sold 100,000 units, and there will be no default. There will be no default in a product. The chances are 70%. There will be minor defaults. Chances are 20%. And there will be major defaults. Chances are 10%. And the total cost of repair, in no default, the total cost will be 0. But if all the goods are defected or have a minor defects, let's assume the total cost will be $20 million. And if all the goods are major defect, have a major defect, total cost will be $50 million. So what will be the value of the provision? For no default, it will be 0. For minor default, it will be 4. and for major default it will be 9. So total $9 million of provision will be recognized. 20% of 20 million and 10% of the 50 million. This is the expected value method, and it is used where the large population is involved in a measurement of the provision, and the example is a warranty cost. And whether we are talking about a single outcome or large population, the above points are still relevant. We will consider all the factors. We will take the opinions from the professionals. Any future change is also considered. Time value for money will be considered if it is material. Okay. You get it? In the following scenarios, provisions are not allowed to recognize. As per IAS 37, we do not recognize a provision for future operating expenditures. For example, provisions are not recognized for repairs and maintenance. Provisions are not recognized for staff training cost. Provisions are not recognized for or to update the assets. Provisions are not recognized for future trading losses. Provisions are not recognized for advertisement expenditures. Provisions are not recognized for like overhauling or inspection costs. For such expenditures, we do not recognize the provision, because in all these examples, there is no past event. There is no past event in all these examples. Repairs will be done in the future. Staff trading costs will be done. Updation will be done. Future trading losses is a future sentence. Advertisement cost will be done in the future. Overhauling will be done, or inspection will be done. For such expenditure, the recognition of provision is not recognized, is not allowed. These expenses relating to these activities expense out when actually such expenses will be incurred, or will be recognized when actually such expenditure will be incurred. Before that, we cannot recognize provision for such activities. Okay, and these are known as future operating expenditures. And the reason why standard do not allow to recognize provision for such activities, because there is no past event involved. There is no past event involved here. You get it? Any questions, students? Updation by asset means purchase of assets. For example, the purchase of property, plant and equipment. We are planning to purchase the property, plant and equipment. The next concept is reimbursement. Now, reimbursement means that the provision expenditure will be reimbursed by the third party. Now, for example, ABC Limited give a warranty to its customers, and the total expected cost of the warranty is $100. So ABC company obviously has recognized the provision, so they have debit the expense and the provision would be credited by $100. Now, there is a possibility that this expense may be reimbursed to ABC company by manufacturer or maybe by the insurance company. Maybe by the insurance company. So if the expense of the provision is going to be given back by any other third party to a company, that is known as reimbursement. Now, in case of reimbursement, remember some points. Number one, it will be recorded if it is virtually certain that entity will receive the reimbursement. If it is virtually certain, then the reimbursement will be recorded in a financial statement. Number two, reimbursement cannot be greater than the value of provision. So if we have a provision of $100, so maximum reimbursement which we can record is up to $100. And point number three, it cannot be netted with provision in statement of financial position. Means we cannot net the provision with the value of the reimbursement. We cannot net them. Now, for example, let's assume the reimbursement value is $80. Let's assume we have recorded a provision of 100, so we cannot do it that we cannot do this, that we cannot record the provision 100 minus 80. This is not allowed. This is not allowed. We cannot do it. Okay, the reimbursement should be presented separately in a assets on a statement of financial position. That means the provision will be shown separately in a balance sheet, and reimbursement will be shown separately in a statement of financial position. We cannot net off the reimbursement and provision into a single amount in a statement of financial position. That is not allowed. Okay, so reimbursement will be recorded separately. It will not be netted off against the value of provision. You get it? These are the notes. The notes will be shared with you by the management. And we are doing chapter number 10. This is a topic which we are doing. We discussed the recognition of the provision. Okay, now this is a case study. Please read the case study. Read it. And these are exam style case studies. This is a style in which the topics will be tested in SBR. Please read the case study. Okay, have you studied this? So, what do you think about this scenario? That an entity in the oil industry cleans up contamination caused by its operation when it is required to do so under the law of a particular country in which it operates. One country in which it operates has no legislation requiring cleaning up, and the entity has been contaminating the land for several years. Now at 31st December X4, it is virtually certain that a draft law requiring a cleaning up of a land already contaminated will be enacted shortly after the year end. What do you think? What do you think, whether in this case a provision should be recognized or not? provision for restoration the land. What's your opinion? Yes, students, I need your input. Provision is recognized when there is a present obligation due to a past event and outflow of economic benefit is probable. Now, in this case, is there a past event? Is there an obligatory event? Yes, a provision should be recognized because there is an obligatory event. The land is already contaminated by the company, and it is expected, it is virtually certain that there will be a law, there will be a legislation which will require the company to clean up the land which has already been contaminated. The law will be enacted retrospectively. So we have a present obligation, there is a past event, and obviously when we clean up the land, there will be an outflow of economic benefit and cost can be measured reliably. So a provision should be recognized in this case. Well done. Now, the second case study. The government has introduced a number of changes in the regulation of the financial service industry. As a result of these changes, entity will need to retrain a large proportion of their employees in order to ensure the compliance with the financial service regulations. However, the retraining is not statutory requirement. One entity affected by the new regulation had not done any retraining before the end of the reporting period. What do you think? A provision for retraining cost should be recognized or not? Yes, a provision for retraining cost should not be recognized because it is a future operating cost. Well done. Now the last one. On 18 December X6, the board of an entity decide, okay, leave it. I will discuss this concept, then we will come to this case study. Okay. The measurement of the provision. Now please read this example on measurement. So a provision of 60,000 will be recognized because it is a single outcome and the lawyer is telling us that there is 60% chance that we will lose the case. So it is probable that the fine will be imposed, the compensation will be imposed. So a provision of 60,000 will be recognized. This is the example of warranty which I have already given you. A company give a 12-month warranty to a customer for any manufacturing defect. If they require minor, there will be 0.5 million cost. If there is a major defects, the cost will be 3 million. The 80% goods will be defect free, 50% will have a minor and 5% will have a major defect. So 15 into 0.5 and 5 into 3, 0.225 million a provision will be recognized. Discounting will be done if the time value for money is material, as I told you, and before pre-tax rate of return will be used to discount the provision. Reimbursement, we have discussed about the reimbursement. For future operating losses, we will not recognize any provision, as we have discussed. Yes, onerous contract. Can anyone tell me that what does mean by the onerous contract? What does mean by onerous contract? Onerous contract mean that No. Onerous contract mean a contract which is a loss-making loss, on which we have expectation that it will give us a loss. Such contracts are known as onerous contract. Now, for example, we have signed a contract and we agree the sale price of the contract $1,000. But now our expected cost become $1,200. So now we have a loss on this contract, expected loss. This is expected loss. And this is an example of onerous contract. Now, onerous contract is our legal obligation. We already have signed the contract. So there is a past event, there is a legal obligation, present obligation, and we have an expected loss of 200. So if we have an onerous contract, the conclusion is very simple, that in onerous contract, a provision will be recognized. A provision will be recognized for expected loss. Restructuring. Let's talk about the restructuring. Dear student, restructuring means a program in which the scope of the business or the manner of doing the business has been changed or is going to be changed. That program, that activity is known as restructuring or reorganization. For example, if a company is going to shut down one of their division, then obviously the scope of business is going to change. For example, if a business is going to change its business practices, for example, from manual system, they are transferring to the automation, to the automatic system. From the man labor, they are going towards the robotic labor. So the manner of doing business will be changed. Instead of conducting classes physically, now they will conduct classes on virtual platform. So the manner of doing business has been changed. So whenever there will be a restructuring, when there will be a reduction in the scope of a business, or whenever there will be a change in the manner of doing business, there will be redundancies. The people will be terminated from the jobs. And when the people will be terminated from the jobs, obviously by law, we have to compensate them. We have to give them redundancy cost, golden handshakes. So whenever there will be a restructuring, we have to recognize a provision relating to restructuring. But that provision is recognized only and only if the management has a detailed formal plan, and that plan has been announced to the people who are going to be affected by that restructuring. If the both conditions are satisfied, then a provision for restructuring will be recognized. But keep one thing in mind, that in case of restructuring, the provision for the future operating costs will not be recognized. For example, provision for training the staff, provision for marketing, advertisement, investment in a new system, updating the assets will not be recognized. But the provision in case of restructuring, a provision of redundancy cost or legal cost, which is unavoidable cost, will be recognized. Okay. So now come back to the case study, which I now read this case study. And tell me that whether a provision should be recognized or not. On 18 December X6, the board of directors of an entity decide to close down a division. Scope of the business. However, this decision was not communicated any of those affected, and no further steps were taken to implement the decision before the end of the reporting period. Okay, now in this case, there is no formal plan, there is no announcement to the people who are going to be affected by this plan, so a provision will not be recognized. In this case, no provision will be recognized because of restructuring, because the conditions are not satisfied. But in this case, on 18 December X6, the board of director of an entity decide to close down a division. On 23rd December, a detailed plan for the closing down of a division was prepared by the board and announcements were made to the employee concerning the redundancies. In addition, letters were sent to the customer advertising them of the proposal and recommending alternative suppliers. So in this case, we have a formal plan. The plan has been announced to the employees and the customer as well. So the conditions are satisfied. So in this case, the provision of restructuring will be recognized. You get it? Please read this case study. Entity Z has constructed an oil rig which is due to become operational on 1st January year 1. The entity has promised that when the oil rig is eventually decommissioned, it will restore the seabed and clean up any contamination that is caused. It is estimated that the cost of decommissioning the oil rig will be 8 million, and that decommissioning will take place in 10 years' time, and the risk-free cost of capital for the company is 10%. The oil rig is depreciated on straight line basis over its economic life. The question is, what will be the accounting treatment for the year ended 31st December year 1? Dear student, the provision for decommissioning cost will be recognized, and it will be recognized at present value because the time value for money is material. And this provision is recognized due to a plant which we are using. So the provision for dismantling cost will be recognized as a part of the cost of property, plant and equipment. Okay, and then it will be depreciated and the provision will be unwinded every year and the finance cost will be recorded. Now, for example, read the answer here. So they have a constructive obligation to repair the environmental damage as a result of the past event, and past event is the construction of the oil rig. So therefore, they will recognize the decommissioning cost and they will recognize as a part of the property, plant and equipment. And this decommissioning cost will be done in a 10 year. So this estimated cost of 8 million will be discounted. And the discount factor at the rate of 10% for 10 year is 0.239. So this will be 1.912 million will be the present value of the decommissioning cost. And with this value, provision will be debited, asset will be debited and provision will be credited on the start of the year. 1.912 million will be recognized as a part of the property, plant and equipment, 1.912, and a provision 1.912 will be recognized at the start of the year. Now at the end of the year 1, now we left with the 9 years. So we will take the 10%. We will take the 10% of this, and this will be the unwinding of the provision, 1,92,000. And this 1,92,000 will be recorded by debiting. We will debit the finance cost and credit the provision for dismantling cost. And at the end of the year 1, the value of the provision will be equal to opening value plus unwinding. And this will become the total value of the provision. If we combine the interest cost and the opening value of the provision, we will get 2.104 million. and the part of the cost of the provision which is recognized as a part of the property, plant and equipment, it will be depreciated over 10 years and it will be the depreciation per year. So at the end of the year, the carrying value of the property, plant and equipment relating to dismantling cost will be 1.720 million. This is a typical example from FR paper for decommissioning cost, for dismantling cost. Future repair of the asset, we discussed that no provision will be recognized for the future repairs, future operating cost. Now contingent liability and contingent assets. Dear students, contingent liability, first of all, let's discuss the contingent liability. Contingent liability is a possible obligation, due to a past event. And it will be confirmed in future by occurrence or non-occurrence of an event which is not under the control of the entity. Now, for example, a customer file a case against you, but the court ordered the investigation, and whether you are responsible or not, it is totally depend on the outcome of the investigation conducted by the investigator. So in this case, it is a possible obligation. If the investigation is against you, then it will become your present obligation, otherwise you will be free. So if you have a possible obligation, not the present obligation, it will be your contingent liability. Or if it is a present obligation arise from the past event, but the outflow of the economic benefit is not probable, or the cost of the provision cannot be measured reliably, in that case also it is known as contingent liability. And for a contingent liability, we will give only disclosure. We will give only disclosure if it is material. The contingent liabilities are not recognized. They are only disclosed in a financial statement. They are only disclosed in a financial statement. Read this example. Please read it. So you can see the lawyers say it is possible that it may be decided against you. So 50-50 chance. So it is a possible obligation. So it will be a contingent liability. So we will disclose only a contingent liability. Contingent asset means a possible asset. For example, if you have filed a case against one of your suppliers, and if it is probable that you will win the case and you will get the compensation, that will be known as a contingent asset, a possible asset. And the accounting treatment for the contingent asset is also same. It will only disclosed in a financial statement. We will disclose the contingent asset and contingent liability in a financial statement. They will not be recognized. They will be only disclosed. The nature of the asset, nature of the liability, and the possible financial effect will be disclosed in a financial statement. Okay. You get it? Any question? Okay, students. Okay, students, it is your first class. We will finish the first class here. We will continue it from the next week. as per our proper schedule. When the notes will be shared with you from the management, please revise this topic from the notes as well. Now from the next week, we will continue with the remaining topics. Okay. If you have any question, if you have any feedback, you can share with me now regarding the class. Okay, we're closing the class before the time due to some technical problems. But from the next week, the things will be fixed and we will conduct the class on a normal schedule. Okay. Any feedback, students? Any feedback? Okay. Okay, students. Okay, students. Okay, then. Okay, thank you very much. Okay, students. Goodbye and take care. See you next week.